Yeah, good evening, everyone. Welcome to the Markets Insight session. First of all, let me wish you season's greetings. Thanks for taking time out in the middle of festivities. As is usual, we will start our presentation trying to just recapitulate the events in the Indian markets as well as what's happening around the globe. Some bit of valuation-led charts we would see. And then post that, today we will have a discussion on UTI Flexi Cap Fund. And again, as is usual, we would have enough time for question and answers. So let's start with our presentation. As you can see here on the first slide, you have the performance over the last 1 month, 3 month and 1 year period. What clearly comes out from the bar charts at the top is the fact that over the last 1 year, small cap segment has been the hardest hit and mid cap part of the market has been the least hit. So, typically while small and mid move together, but this time we have seen a huge divergence with small cap showing big underperformance, large cap somewhere in the middle, and mid cap being very, very resilient. And that's something which we have seen even in the near term, actually over the last, I would say, 1 and 3 months as well. As far as sectors are concerned, again, the big picture here is that the worst performing sector over the year and the underperformance still continues in the last 1 and 3 months is the IT sector. That's been pretty much the worst hit sector. Along with that, the pharmaceutical sector and the healthcare sector has also been a poor performer. When it comes to the best performers, the PSU and the auto sector, the PSU banks and the auto sector have been the best performers. And I would say, even in the near term, auto has shown a fair amount of resilience. Yeah. If you look at the markets per se, then this shows you the performance of the markets over various emerging as well as developed markets over the last 1 year period. And no surprises that Brazil has been holding up very, very well. Brazil, as we all know, is an economy which exports a lot of commodities. And in an environment where inflation is hot and commodities have done reasonably well, Brazil has also benefited. Economies which actually are importers of commodities have been the worst hit. India, of course, has been an exception this time. India has been able to not only have strong outcomes in terms of economic growth, but also in terms of the stock markets, despite a very heavy pullout by FPIs and FII or overseas investors, I should say. Indian markets have been able to hold on in a narrow band, partly also because of the strong flows that we have seen domestically. And equally, we haven't seen any panic selling in the Indian markets because, like I mentioned, India remains one of the very, very few economies. And if we consider size as one of the factors to decide the universe, then amongst the large sized economies, India really remains the only one which can still talk about a 5 to 6% growth. Even otherwise, if you expand the universe and take large size as well as mid sized economies, India still would be one of the very few ones which can talk about 5 to 6% or 5 to 7% kind of real GDP growth. And I think that's been the reason for India doing reasonably well, both in terms of our currency as well as in terms of the equity markets. Yeah. This is basically the movement in terms of the core earnings growth in the economy. The long range number, as you can see at the top, the almost 30-year number at the top is 11%. But this 11% is basically, extremely volatile. So we see periods of 20-25% kind of growth. Equally, we also see periods of very, very muted growth. I would say pre-2020, for a very, very long period of time, I would say almost a decade, we saw extremely anemic growth numbers, 6% CAGR, as you can see on the screen. But, these numbers have now started to move up significantly. As you can see from FY21 to 24, it's expected that these numbers would actually move up at the pace of 22%. We've already seen strong earnings growth last year, which is the year ending FY22. This year, which is the year ending FY23, unfortunately, earnings growth is not going to be high, although sales growth is still going to be high. And the reason for that is inflation, which is leading to pressure on the operating profit margin. So the present year will still show reasonably sound growth insofar as the sales growth or the revenue growth of corporate India is concerned, but it may not be able to translate into strong earnings growth because of inflation and its consequences on the margins of companies. But the underlying growth engine still seems to be going fine despite inflation and despite increase in interest rates. Yeah. We go on to the next one Niranjan, can we move to the next one? We can skip this. Yes, this is on the valuations of the market. So if you look at the value, I think Niranjan, we've come forward. We need to go back. I think there must be a slide before this. Yes. So if you look at the valuations of the market from a trailing price earnings multiple as well as forward price earnings multiple, I think fact remains that we are between 10 to 15% higher than our long-term averages. And in fact, I would say that there has been some bit of correction in the markets over the last week or so. So these numbers would have actually come down, but we would still be between 5 to 10% at least higher than our long-term averages. And I think this is the only niggling worry, if I may say, that one would have about the direction of the Indian markets over the next few quarters. One usually gets much more comfortable when markets are either at their long-term averages, and certainly much more comfortable if markets are below the long-term averages. Today, because we are a tad higher than those averages, there seems to be some bit of discomfort, rightfully so. But yes, like we have seen in the last 2 or 3 quarters, markets correcting by 10% is something which can happen, within 30 days flat. So without calling out the direction of the market, all I can say is that any correction in the market will certainly bring it down very close to a long-term average. We have already cleared this time period when our valuations were significantly higher than our averages. As you can see on this chart, same time last year, our valuations were, believe it or not, 30 to 40% higher than long-term averages. And that time, clearly the markets were completely overvalued. But over the last 12 months, there has been some bit of price correction, but there has been more of a time correction. Earnings growth, like I told you, in FY22 were very, very strong. Earnings growth were reasonably strong in Q1 of this year. So therefore, because of both of these factors, which is some extent prices coming down and to a great extent earnings actually moving ahead, has led to the final outcome on price earnings multiple coming down within striking distance of long-term averages. And if there were to be more correction in the markets in the coming months or quarters, I would say that we would really get into healthy and attractive zones. Yeah. Very similar is the chart on price to book value. Here also, as you can see, maybe about 5 to 10% higher than long-term averages. The good point, however, is on the right-hand side, where you can see that return on equity for the Indian markets has moved up, which is always a good sign because, like we always say, the price that you should be ready to pay to a business is dependent on its return on equity and its long-term growth potential. Likewise, if you consider India to be a stock, then the return on equity of corporate India moving up is always a healthy sign, and that should lead to Indian markets continuing to command a price earnings multiple higher than most other emerging markets. If we roll forward, you can see the valuations for the mid cap and the small cap segment of the market. Now, this is where we see valuations are still, I would say, higher than long-term averages, and as a percentage, the overvaluation in mid and small cap segment of the market is more than what we have seen in the large cap part of the market. And this is represented by the next chart as well, which is the difference between the long-term valuations of mid caps versus large caps. And if you look at this chart, you can see that the longer-term relationship between mid caps and large caps is that of parity, which basically means that on a forward multiple basis, mid caps and large caps trade at very, very similar valuations. However, as things stand today, mid caps are trading at a 21.65% premium to large caps. So either large caps will move up in the next 12 months or mid caps will have to correct in the next 12 months. Which one of these two things will play out, only time will tell. But clearly, if you respect data over a longer duration, then the one thing that comes out very clearly is the fact that mid caps ought to actually bridge this valuation gap that they have with the large caps. And this is also showing up in the relative outperformance of mid caps versus large caps over the last 1 year. In one of the initial charts that we saw, we did see that mid caps have been very resilient. They've hardly seen any decline over a 1 year period. And that's because their valuations haven't corrected as much as the valuations of large caps have corrected. Yeah. Okay, so the key takeaway after looking at most of these economic vectors is the fact that today most markets globally are dependent on the policy actions of the Fed. The Fed, in turn, is very, very clearly looking at just one thing, which is inflation. Its enemy number 1 to 10 right now seems to be just inflation, and therefore to counter that inflation, it's been increasing interest rates. Most economists are of the view that this heightened action on increasing policy rates will certainly lead to recession happen sometime in 2023, which possibly would be the time when Fed would want to reverse and therefore would want to start reducing interest rates in order to again induce growth into the economy. Apart from this, the world, because of the ongoing war, has been facing challenges in terms of energy. There are to some extent challenges on some of the other commodities as well that come from Russia. But energy is basically front and center right now for most economies. And, here again, prices remain elevated. However, for both commodities and energy, the one thing that we would want to actually bring to the notice of all of our distributors and partners is the fact that if the global growth gets marked down and if recession indeed happens in US and Europe, it would be very difficult to imagine a scenario that commodity prices and energy prices will remain strong. We have already seen over the last few months some movement, some downward movement in commodity prices and energy prices because most people are getting nervous about the growth outlook for the globe as a whole, for world as a whole. And I would say that if we keep moving closer and closer towards slowdown and then eventually recession, the hardest hit part of the markets would really be commodities, including energy, notwithstanding the supply side shocks that we are getting on account of sanctions against Russia. As far as our own situation is concerned, I would say, yes, even we are going through a phase of high inflation. But to put this into context, the inflation of India being around 7%, when our average, our long-term average itself is 5.5%, is not really a big problem to confront. Imagine countries like Germany, where inflation has reached 11%, and it's being seen as the highest inflation ever in Germany after the World War. Or inflation in US, which itself is, in the corridor of 7 to 8%, significantly higher than their long-term averages of 2%. So I think from that perspective as well, India as of now seems to be in a reasonably sweet spot. We are facing pressure on account of Fed increasing interest rates, which is having an impact on all currencies, India included. So therefore, to also counter that, we may have to, effect some more increases in our policy rates. But on balance, the situation is not so bad. Our external debt is very, very manageable in the context of the $550 billion of reserves that we have. Yes. Let's move on, Niranjan. Okay, now let's start to discuss the UTI Flexi Cap Fund. Let me start by reiterating the core philosophy of UTI Flexi Cap. You've heard me before, but I still want to remind all of our partners, especially because of the near-term performance over the last 6 and 12 months. You see, we've always said that UTI Flexi Cap stands for buying high-quality businesses. We've maintained that the long-term wealth creation that we all aspire to generate, in case of UTI Flexi Cap, is going to be built around buying great businesses and holding on to them very, very patiently. And the way to generate wealth out of these businesses would be simply the value creation or the economic value that these businesses generate. This strategy has never been about finding out which are the cheap businesses, which are those businesses which are trading at a discount to their intrinsic value. Let's buy them, let's hold them for a couple of years, and when when the price becomes very close to the intrinsic value, we'll sell out and then hunt for something else. That has never been our strategy. Our strategy very, very clearly has been about buy good businesses, buy businesses which have strong balance sheets, which have strong cash flow generation, which have leadership position within the industry where they operate, where they have amazing pricing power and therefore have strong and sustainable margins, and all of this leading to strong return on capital employed. Our strategy has been to identify these businesses, and then once identified, holding on to them very, very patiently for a very, very long period of time. Now, when we hold on to these businesses for a long time, it is only obvious, and I will show that to you in the form of different charts later. It is only obvious that their stock price will not be a one-way street. Their stock prices will keep moving up and down. There will be phases when their stock prices are hugely underperforming the market, just like there are phases when their stock prices would be hugely outperforming the markets. But on balance, if they really are these great businesses, then over long-term periods, they should actually outperform and create alpha for investors who have been holding on to them very, very patiently. That remains the focus of our strategy, and we have not digressed one bit from this. India's most efficiently run bank like HDFC Bank may not be the best performing stock in the last 2 years. Maybe something like a Bank of Baroda could be the best performing banking stock of the last 1 or 2 years, but that doesn't mean that HDFC has lost its edge in terms of being the best bank, and Bank of Baroda has now displaced HDFC to be the best bank. Price movements in the short run never give us any signal about whether we are on the right path or not. Whether we are on the right path is determined only by studying the businesses in terms of the outcomes versus what we expected them to be. And this is where I can say that there have hardly been any changes in the portfolio in the last 12 months. We haven't felt uncomfortable about anything that we've been holding in the portfolio and therefore selling it out. There have been only 2 exits from the fund in the last 12 months, and they were purely on account of growth being slightly lower than what our expectations were rather than anything else. So just to sum it up once again, we are sticking with our very, very strong focus on high quality businesses. We know that these are the businesses that will ultimately generate long-term wealth and superior wealth compared to the markets. Within this set, we are looking at businesses which have strong growth drivers in the long run. We don't like businesses which have a weak growth outlook. We want the underlying businesses that we own to keep compounding, and that can happen only when they have a long growth runway. So we look at businesses which, because of a variety of reasons, can continue growing at a few percentage points higher than India's nominal GDP growth, at the least. The last part is valuation. The strategy has always been more expensive than the benchmark. We have always seen this. There's a chart on this one as well, which I'll show you in a bit. But the point here is that, like I mentioned, strong businesses that display high return on equity and also show strong growth will always be expensive. Like I love to say, I haven't seen HDFC Bank or Kotak being very cheap in the last 2 decades or more, 2.5 decades, I should say. Equally, I have never seen something like an SBI or a Bank of Baroda trade at extremely high valuations. So cheap is often cheap for a reason, expensive is often expensive for a reason. Price earnings multiple is something which we use as a shorthand to figure out the valuation, but we often make mistakes because we end up comparing apples to oranges. Certain businesses optically would look expensive because their PE multiple is high, but actually they may not be so. Intrinsically, they may not be so despite a high PE. And certain businesses may optically look to be very cheap because they have a very low PE ratio. But despite that low PE ratio, they may not actually be cheap. So let's move ahead, Niranjan. This is the portfolio in terms of large, mid, and small. In terms of the breakup, we all know approximately 35-36% of the portfolio is in mid and small caps. The remainder is in large caps. We've always, managed this fund with mid plus small cap exposure being between 30 to 40% and large cap exposure being between 60 to 70%. We never want to actually take a call on whether mid caps are cheap, therefore we should increase exposure. We've always said that this is a purely bottom-up strategy. We don't look at the benchmark to decide which sector we should overweight or underweight. Equally, we don't look at the valuations chart to figure out whether we should have more of mid caps or more of large caps. We just go out there to figure out which are the best businesses across large, mid, and small. Being a flexi cap strategy, we have the flexibility to be across all of these 3 sectors in whatever proportion we wish to. We just utilize this by trying to figure out which are the best businesses out there, regardless of large, mid, small, which ought to be there in this portfolio. Which are the ones which can create the maximum amount of economic value over the next 10 years so that it translates into the maximum amount of wealth over the next 10 years. Yes. And here you can see how static we've been in terms of our large, mid, and small. Even if you were to take a longer period, you would see that it hasn't changed much. Active share is also high at about 65%. Because of the reason that I just mentioned, we are not looking at the benchmark to actually decide what should be there in our portfolio, what should not be there. We don't like energy, it's 0. We don't like metals, it's 0. We don't like construction, it's 0. We don't like aviation, it's 0. So there are many sectors which are 0 because we just don't like not just the industry, but we are unable to find businesses that have the kind of strong economic characteristics that we like. Yeah. We move on. Now, these are the top 5 overweights and underweights. Haven't changed much. Again, I should say, Reliance still continues to be a big underweight for us. So does ITC, so does Hindustan Unilever, so does L&T. On the right-hand side, we see the big weightages in our fund coming in from financial services, IT, consumer services, healthcare, consumer durables, auto. And like I said, at the bottom, you would see many sectors where we are 0, despite the benchmark having reasonably strong weight there. We are 0 in power utilities, 0 in oil and gas, 0 in metals, 0 in construction, and so on. Yeah. Now, this is an important slide. Like I mentioned, there has been a sharp underperformance in the last 12 months, as you can see on this slide. And let us just very quickly discuss the key reasons for our underperformance. Now, one set of underperformance is emanating from the fact that we don't have those sectors which have done really well. So we don't have the metal sector, we don't have the energy sector, we don't have, the PSU banks and the PSU sector per se, which has done very well in the portfolio. We don't have power utilities as well. So not owning these sectors, which have actually done very well in the last 1 year, has been one source of underperformance. Equally, the other source of underperformance has been from some of our key holdings, and I would say not just holdings, but key sectors which have been underperformers. IT clearly is one of them, which has been a very big underperformer in the last 1 year. Consumer services, and here I must tell you what all comes under consumer services. So the B2C or the consumer facing internet names like InfoEdge is counted under consumer services. And we all know that InfoEdge, which has been our top 10 holding, has not done well in the last 12 months. Equally, some of the other internet businesses like IndiaMart are part of consumer services. The other big drag from consumer services is coming from Jubilant Foodwork, which is a quick service restaurant name, something on which we are very bullish from a longer term perspective, but equally it has been a big underperformer in the last 1 year. Healthcare as a sector, unfortunately, has not been doing well in general, and for us as well, it hasn't done well. Our healthcare stocks, while we may be bullish on them from a longer term perspective, while they are indeed some very strong quality franchises with strong balance sheet, but they haven't been doing well. Equally, diagnostics, because of fears around competition and also on account of business being slightly weak in FY23 compared to FY22 and 21, because the COVID testing revenues are gone, has also been an underperformer, although our view from a medium to long-term perspective in case of diagnostics also remains strong. In fact, as has been our behavior all through, what we have done in the last 6 months and 9 months, ever since this huge, I would say, correction started in high growth names, is that we have only been increasing our exposure. In fact, if you look at InfoEdge, since I gave that as an example, while InfoEdge stock has corrected by more than 40%, but you must also realize that this was a stock which was close to 3% in our portfolio. Even today, it is at 3% in our portfolio. We've been buying InfoEdge all along in the last 2 to 3 months in particular, ever since the correction has been extremely sharp and to some extent unwarranted. And that's the behavior we have had across many other businesses, which we like from a longer term perspective. And to our mind, they are available to us 30-40% cheaper, because there seems to be a shift from growth towards value investing, number one, and B, in terms of the outlook for these businesses, just in the near term, it seems to be a little cloudy. But these are extremely, I would say, attractive and rewarding time periods for someone who's wanting to increase exposure or build exposure into sound businesses, which really over a medium to long-term period remain the best candidates for long-term wealth creation, although from a very near-term perspective, their outlook would be cloudy. Yeah. Let's move on. These are some of the additions and reductions in the portfolio. I would say many of our businesses which have actually gone, which had seen a serious correction, are the ones we have actually increased on the left-hand side, whether it is Berger Paints, InfoEdge, Titan, of course, did correct in the months of May and June. Avas, Mindtree has seen a sharp correction, so has Gland. Avenue Supermarts corrected significantly in the months of April and May, and we were increasing exposure. So is the case with Infosys and Coforge, where on an ongoing basis, we are still building exposure. On the other hand, we have actually reduced exposure into certain stocks which haven't seen a big fall. Schaeffler being the biggest one, where it continues to surprise us in terms of valuations. AU Small, which haven't corrected so much. Similarly, Torrent, Grindwell, we've been reducing exposure. So typically, you would see us never exit a business completely until we are not comfortable about its future growth outlook. Whenever valuations move up, we would actually prune down exposure from these stocks where valuations have gone up, and we would actually invest that money into, again, good quality companies, which for one reason or another are seeing a decline in the short term. I can preempt a question on HDFC Bank and HDFC. Why have we been selling? They continue to be I would say HDFC Bank continues to be one of the best managed banks in the country. But because we know that they are going to get merged, and because the swap ratio is also already announced, I'm already looking at HDFC Bank and HDFC Limited as one single exposure. And that one single exposure was as high as 8% when this was announced if I'm not wrong, in either February or March of this year. And since you would have seen us, we are never comfortable having the top holding as high as 7 or 8%. We have been slightly reducing exposure into this combined entity and maybe increasing exposure into other banks like ICICI and maybe NBFCs like Aavas. Yeah. Okay, on the valuations per se, yes, UTI Flexi Cap, as we all know, is always more expensive than the benchmark. It's indeed the case today as well. You can see here that over a 10-year period, the overvaluation of Flexi Cap is around 55%. That's the average premium of UTI Flexi Cap over Nifty 500. And this premium is because we don't have SBI, but we have HDFC. We don't have Bank of Baroda, but we have Kotak. We basically don't have, let's say, an ITC, but we have a Nestle. Equally, when it comes to, auto sector, we don't have a Tata Motors, but we have a Maruti. So it's only obvious that our portfolio will be more expensive than the benchmark because we are really playing with the best quality names. But the interesting thing is that our premium versus the benchmark itself keeps moving around the average. There have been periods when we have been lower than the benchmark, and there have been periods when we have been much higher than the benchmark. Such has been the huge underperformance in growth versus value that within the last 12 months, from being significantly higher than the average, we have come down below the average, and we are very close to the lows of the last decade. So today, the overvaluation of Flexi Cap is pretty much at the low point of the last full decade on account of the sharp underperformance that growth has seen versus value. I don't know when this will reverse, but I'm just sharing a data point with you in terms of where we are in terms of, let's say, the growth to value shift that we have been seeing over the last 2 years now. Yeah, next. Now, this is an interesting slide. In fact, we have a few of them, and this is again to prove a point which many of us know, but many of us equally forget whenever bad times fall on us and whenever our strategy is going through near-term challenges. So we know that Info Edge is a great business, has been a great stock to own as well. It's given 26% CAGR over the last 12 years. Despite the fact that it has fallen more than 40% in the last 6 months, and the ending point of the study is 8th of October. Despite that, it is still a strong candidate in terms of wealth creation. But the fact is that to really achieve this 26% growth in terms of, I should say, stock price performance or growth in the stock prices, you had to endure many periods of swift corrections. And swift corrections have been happening in Info Edge ever since 2014. They happened in 2015. They happened in 2019. They again happened in 2020. They happened in the early part of 2021. And after that, it went on to make a big high. And then in the last last 9 months, I would say it's fallen about 50% from the peak, has recovered, but is still down 40%. So, even the best of businesses will go through these corrections time and again. Growth stocks do grow through these bouts of very swift correction. There is nothing abnormal about it. But it's your ability to continue focusing on the business and the outcomes of the business. And if the outcomes continue to remain strong, then you need your ability to hold on to them with tenacity and with a lot of conviction, which ultimately leads you to create wealth. So selecting a great business is one skill, but believe me, holding on to these great businesses whenever there are these near-term pulls and pressures is an even more important skill. And this gets repeated in not just a stock like Info Edge, but many other names. And let's quickly, now that the story is well explained, now just let's look at these charts very quickly, Ranjan. Jubilant Foodwork, the same story, 27% CAGR till over the last 12 years till last week. It's fallen about 35-40% from the peak. Is it the first time that it fell? No. It fell 30% in 2014. It fell 50% in 2015. It fell another 33% in 2018. It fell 36% in 2020. If we go on to the next one, which is basically Mindtree, again a great business, 30% CAGR. IT is in the eye of the storm today. Most people have been saying, what do we do about IT businesses? My answer, these are one of the best businesses that the country has to offer. We've seen 30 years of the IT industry, and the fact that it has been one of the best industry in terms of giving stable outcomes on cash flows, return on capital, balance sheet, and also professionally managed. Is it going to be a smooth sail for businesses like Mindtree? It never has been, and I would say it never will be in the future. Despite that, they are candidates for great wealth creation. To get this wealth, you had to endure a 20% fall in 2013, a 45% fall in 2016, a 34% fall in 2018, and a 45% fall that we are seeing today. So this is par for the course. I think there is another one. We can very quickly go through that. Niranjan, Divi's, a great healthcare company, India's largest success in terms of contract manufacturing and selling APIs to the big pharma companies. We keep talking about China plus one. I think that's a question everybody asks me. I would say if there is really one big candidate for China plus one, it's a company which is tried and tested over 2 decades, has created strong wealth. Of course, maybe down more than 30% today, but it's not the first time that it's seen this correction. As you can see on this chart, it also did see a 60% correction in 2017. So, nothing unusual about great businesses witnessing big falls in the short run. If you have the ability to hold on to them because you have an understanding about their business and the outcomes of these businesses over the long run, then I think you would be able to create, strong wealth in the medium to long run as well. Yes, Niranjan. Now, here's an important study. I think just last 2 slides left before we open up for Q&A. Now, people also come back to us and say, doesn't it make more sense to actually, buy these high quality names when the valuations are favorable? Why should we hold on to high quality names even when they are expensive? Why don't we actually sell them and wait for a time when they're not so expensive? So we thought, let's just do a study to figure out, can you time these high quality names? Is there any, a big alpha that you can create by timing them? And we did a simple study. Let's concentrate on the left-hand side table, quality names. These are high quality names from our portfolio. We've just tried to represent as many sectors as possible. Some of these include stocks that have done very well. So all of them would have done well over the last 10 years. Some of them have done horribly in the last 1 year. Some of them have still done okay in the last 12 months. We've just had an assortment of all kinds of stocks. So, the simple thing we've done is, let's assume that you have 2 kinds of investors. One who feels that he can't time the market. His job is only to buy a high quality business and then hold on to it for long. He invests with discipline on a particular time every year. So we have assumed that an investor A is investing 1 lakh rupees on 1st of Jan every year, regardless of what the stock price of these high quality stocks are. If you do that for Asian Paints and you do it for 10 years, then you've accumulated 48.42 lakh rupees, as you see on the left. Investor B is the one who feels that there is always value when you buy at a favorable valuation. Buying at a high valuation can never create wealth. Therefore, one must always keep valuation in mind. Nothing wrong with that thought process. But let's also look at the final outcomes. So this gentleman basically invests at the lowest point of every year. We all know this is a theoretical exercise. We all know there can never be an investor who exactly knows what will be the lowest point of let's say Asian Paints in a particular year. But this gentleman has been able to do it for 10 years back to back because we have the history in front of us. So we know what the low point is. Despite taking advantage of this, all that he has delivered is a sum of 51.59 lakh rupees, which is, believe me, only 6.6% higher than investor A, who did not time it. If you do this exercise across the board, across different companies, what you realize is the difference is on an average only 10%. I did show you that companies like Mindtree fall 30, 40%, even 50% at times. InfoEdge has fallen 50% twice. So have many of the other companies. But despite taking advantage of this 10, 20, 50% fall, the fact remains that if you hold on to these stocks for a very long period of time, the difference is not going to be much. You do the same exercise for the typical value names that you see, a Hindalco or an SBI or a Tata Steel or a Coal India, then you realize there is a difference. The group on a whole has an average difference of 35%. And the reason for this difference is that value stocks are the one where you have to buy them when they are very cheap and you have to sell them when they are cheap. So you cannot, if you hold on to these names for a very long period of time, if you hold on to Tata Motors through thick and thin, you will never be able to make money. So you have to go in swiftly at a particular valuation, come out very swiftly at a valuation which may still be cheap, but may not be terribly cheap. In case of high quality names, the big money that you make is out of your ability to hold on to them till such time that these businesses remain very, very strong. Last slide I want to show you today is basically what drives long-term wealth creation. We've always said this. I thought it's always important to put this in terms of some data. I am again using the same quality portfolio and the value portfolio that we've shown on the previous slide. Over a 15-year period, the quality portfolio has given return on capital or ROE. In case of banks, we have taken ROE. The average turns out to be 40%. For the value camp, this number comes out to be 10%. Because we are choosing high growth businesses, the earnings growth of this portfolio over a 15-year period has been 21%. Because the typical value stocks are extremely cyclical, so they give you very strong growth for 2-3 years and then they fall off, sometimes may give you even negative growth. Their long-term growth is just about 7%. And therefore, because of these two factors, over a long run period, over 15 years, the quality portfolio would have given you 26%, or value portfolio would have been given you 8%. But to get to this 26%, you had to endure and remain very, very patient with that portfolio. Over a shorter time period, as shown below, quality has hugely underperformed value. The quality portfolio that we have studied over the last 2 years has given us only 36% CAGR. Value has given 65% CAGR. And clearly, we are underperforming. But despite that, if you look on the left-hand side of the same table, there is no difference in terms of the outcomes, in terms of the business and their profitability. Quality is still very high at 37%. Do remember, this is the period of COVID. So there has been some amount of reduction in the ROCs, and value is still at 9%. We have not taken the growth numbers here because over the last 2 years, growth numbers were not possible for the entire group because there were many companies on both sides which went from, which did show losses. So it was not coming out to be a number which can be relied on. But the big message is that the quality attribute of these businesses has not changed despite the pandemic. But yes, because of the big shift, we've seen a massive underperformance. In the long run, like they always say, wealth creation is a function of underlying earnings and cash flow growth and growing these cash flows very, very profitably. So long as this basic truth prevails as the key tenet of investing, I don't think we need to change anything in terms of our core philosophy in UTI Flexi Cap. So I'll just stop here and maybe we can open up for Q&A, Niranjan.
Yeah, sure. Thanks a lot, Ajay, for that detailed overview on the markets and also on the UTI Flexi Cap Fund. It was pretty much music to hear, and also you shared a lot of insights. Thanks for that. In fact, just a reminder to the participants, while we have already received a lot of questions here, please do use the chat box to ask your questions, and in the next 15-20 minutes, we will take as many questions as possible. And the first question for the evening is coming from Mr. Subhash Chandra More, and a few more as well. And the question goes like this: what is your prognosis on escalation of tension between Russia and Ukraine impacting global and local markets in the midst of today's high inflation regime?
Yeah, so, we did make a passing comment on this. The war is definitely leading to supply side challenges on energy much more than anything else. But I also did mention that the war itself is leading to crisis in Europe, which means growth slowdown in Europe. to some extent, it's leading to problems in US as well. Of course, US is facing a different challenge in terms of fighting inflation and therefore pushing the economy towards recession. But Europe is, apart from high inflation and interest rates, is also facing a problem in terms of energy challenges. Germany, which is the manufacturing destination within Europe, is facing terrible problems on account of either non-availability of gas or very high prices of gas. So the world is slipping towards slowdown and then recession. And during recession, like I mentioned, demand for commodities is always brutally hit. So ultimately, this war is going to push things down in terms of overall growth for the world, for the globe, which in turn will have an impact on commodity prices itself. And that usually is a good thing for an importing country like India. Although do remember, India is also interlinked to the world. So when the world grows slow, it will have an impact up to maybe 100 basis point on our GDP growth as well because of this weaker global growth. Yeah.
Thanks, Ajay. The next question is on the UTI Flexi Cap Fund's exposure in mid and small caps. The fund has about 35% allocation. So what is your view on this exposure on the backdrop of stretched valuation?
Sure, that's a good question. We did mention when we were discussing large, mid, and small that our outlook or our let's say weightage in any particular market cap bucket is never driven by valuation, overvaluation or undervaluation. Our view is always more on the business. Yes, we have seen pockets of overvaluation in mid caps. In the screen that in the slide that you saw on our exits and our entries, you did see quite a few names from the mid cap segment where we were pruning down exposure, like a Grindwell Norton, like a Schaeffler, like an AU Small. So we've seen that and we have done that in the last 6 months. We never drive the portfolio in any particular direction only on the basis of valuation. If you remember the slide that we showed, which basically gave you the core philosophy of FlexiCap, it started with quality, it went to growth. The last factor there was valuation. Valuations do matter to us, but they come at the very end in terms of our entire stock selection framework. It always has to start from quality. So even if mid caps are slightly more expensive, we will continue holding on to those mid caps, which are basically giving us a very strong outlook in terms of value creation over the next 5 to 10 years. Yeah.
Thanks, Ajay. There is a question coming from Mr. Ashutosh. This is on the DXY index. How do you see the DXY index strengthening, impacting the USD and also the INR?
This is something which is more about the direction, and we all know that it's very difficult to talk about direction, but we can only look at history and make sense out of this. History teaches us that whenever there is a risk of dollar gains strength, dollar index gains strength. And whenever, the times are much more favorable, whenever you move into risk on, whenever emerging markets actually become, a focus area once again for global investors, dollar index starts to lose strength. It is amply evident that today the world is going through a bit of a scare, both in terms of increasing interest rates and the war. And therefore, people want to be more and more into the world's most productive and the most well-managed economy, which is US. And therefore, they want to base most of their investments into US dollar rather than anything else. So it's right now gaining yields by investing into emerging markets, which give a higher yield, or gunning for growth, which again emerging market equities will give compared to the US equity markets, is not at center stage. This is now at the back burner. Today it's all about protecting downside, and downside protection would happen the best when you go back into dollars. That's why dollar is showing strength. My opinion about this, quite frankly, it is impossible to figure out when would dollar weakness start, when would the dollar index start to come down. Till the time the sentiment is vicious, this will remain. But equally, history also teaches us that whenever good times come back, the dollar index again starts approaching towards 100. So that will also happen at some stage. Yeah.
Sure. Thanks for that, Ajay. There are a few questions on sectors, so we will take them now. First one is coming from Mr. Mohit Madiwala. His question is on IT. So what is your take on current valuations of specialized IT stocks, also mid-sized IT companies? How comfortable are you with overweight exposure to this sector?
Sure, that's a good question, given the fact that IT has been a source of underperformance for us. We are extremely positive as far as IT is concerned. Again, let me draw your attention back to the slide that we showed, where we were showing you what have we bought in the last 6 months or 12 months. You would have seen a lot of IT names there. We've been buying these IT companies in the last 12 months. And this is because we are bullish on their longer term prospects. You know, the one thing, and TCS declared its results yesterday, don't look at the stock performance, only look at the quality of the results, which were very, very strong. You know, showing 17-18% kind of growth is no easy task today. And maintaining margins is again no easy task today, but that's what, you know, TCS has been able to demonstrate. Of course, the smaller and the mid-tier companies would be able to grow faster than TCS. Size is a bit of a disadvantage for TCS at this stage. But the messaging given by the management of TCS was that, yes, clients are anxious. Yes, clients are somehow also looking at how much they need to spend on technology. But equally, and this is something I have heard many times in the last 15, 20 years. This is not the first time I'm hearing this. Most clients say that if it really comes to cutting down costs, then our tech budgets will be the last one to be cut. We will cut down on froth elsewhere first. But technology, which is basically for the longer term productivity of our organization, giving the best kind of customer satisfaction to our customers, is something which will be cut towards the end. So I can just assure you one thing, IT will be more discretionary than the consumer sector, but it will still be much less discretionary than many other things. All of the commodities that we are bullish on, hotels, hospitality, aviation, if growth comes down, don't assume that people will still travel out of generating wealth from thin air and continue spending on hotels and aviation. If slowdown happens and if indeed unemployment rises, there is going to be a big impact on many discretionary sectors, which today in the last 9 months may have enjoyed the party on the stock market. But in terms of their business outcomes, it could really be extremely negative. So from that perspective, IT, zero debt, high cash generation, best of managements in the country, plus even during recessions have managed to show growth, is a sector we are ready to back, also because valuations are much more attractive today.
Yeah, sure. The next one is among the largest sector weight for the fund, there is a significant overweight position in consumer services. And it has reasonable underperformance again. So in the last couple of quarters. So what are the headwinds that could delay the near-term growth for the sector?
So Niranjan, I did explain this when we were talking about attribution. Consumer services for us are some internet names like Info Edge India Mart. It is also for us certain names like Jubilant Foodwork and also a company like Nykaa. All of these businesses, while they are doing extremely strong, but because they are perceived to be high growth, have seen a very strong correction in their prices, 30-40%, even 50%. Now, this is what I was trying to explain, also using those charts, that we have to look at the performance of the business as distinct from the performance of the stock price. We are never influenced by the stock price. We are always looking at, is Info Edge going to, generate strong growth in the coming years? Does it have a leadership position in Naukri? Does it have a leadership position in 99 acres? Does it also have a very strong investment in not only Zomato and Policy Bazaar, but a host of companies where it has been investing over the last 5-6 years? And I think nothing has changed insofar as that is concerned. The stock price has come down. We've been actually increasing exposure in Info Edge is all that I can say, because we are extremely bullish about its next 5 years. So yes, consumer services may have seen a big decline and therefore a negative source of performance for us, or rather underperformance for us. But our view on these businesses has not changed. Our view on Jubilant in terms of how many stores it can add, how many more people can actually be recruited as customers, its ability to launch other formats has not changed one bit between now and January of 2022. Yeah.
Yeah, sure. Thanks. There is one question coming from online. Mr. Pramod Naik is asking. So, given that the current valuation of large cap being above long-term average, and also the mid and small cap tends to be in the expensive territory. So, how should one be looking at the developed market in arena? How well the Indian market is placed compared to the developed market?
Niranjan, I'm sorry. I mean, I got confused about the question. Is the question about Indian markets versus developed markets?
Yes.
Is there a separate question about mid caps?
No, given the expensive valuation in the mid and small cap, should one be looking at the developed markets at this phase?
No, I mean, I don't think this is a right narrative to draw. If for someone mid and small caps are expensive, rightfully so, then obviously you have large caps in the Indian market which are not so expensive compared to the history. Like I said, maybe 5 to 10%. See, just like we talk about patience and discipline, we also have to look at our own asset allocation from a longer term perspective rather than looking at asset allocation from a here and now perspective. So because India is expensive, should we move money overseas is never a right strategy. First of all, let's look at the long range data. Except for US, there is no other developed market which has outperformed India over a 30-year period in dollar terms, by the way. I'm not talking about rupee. So yes, there is a case for investing into US equities to diversify ourselves, and we should invest. I have been saying about at least 10% into something which is outside of India. The best candidate to my mind seems to be US. If somebody wants to have a more diversified global fund, so be it. But that's a more strategic call that you take. It's not a call that, look, India is expensive today, therefore let me go to US. When US becomes expensive, I will go back to India. I don't think asset allocation decisions should ever have such a very short-term here and now focus. So I would say investments into global assets make sense. Yes, start building your exposure into global equities, predominantly US. It's a good strategy to have in the long run. Yeah.
Sure. Thanks, Ajay. In the interest of time, I think we will take last 2 or 3 questions more. One question on the pharma sector. Despite of high growth potential of pharma sector, the year-on-year growth of the sector continues to be tracked. So what is causing the degrowth and what are the pockets of opportunity?
Sure. See, the longer term opportunity in the healthcare sector is exactly the same as it was 10 years back and 20 years back. India is having a very, very poor number in terms of per capita spend on healthcare. I can give you the numbers of per capita spend on pharma, and pharma basically means the medicines that we take. That number is $20 per annum. It's a very, very low number. I would say it's an embarrassingly low number for a country like India, which is the 5th largest economy today. The same number for emerging markets is $200 per annum, and the same number for developed markets is $800 per annum. We are basically just 10% of emerging markets, and we are just about 4 or 5% of developed markets. So the long run picture for healthcare is that as disposable incomes improve, we would see spend towards pharma increasing. This is a trend we have seen over the last 20 years. This will not change over the next 20 years. Is something which we are very, very comfortable with as a hypothesis. How the sector has performed in the last couple of years is another thing. What we are focusing on, by the way, are only the domestic focused pharma companies. We are not into generics, which is a sector which sees a huge amount of price competition. Return on capital is low. Pricing power is not there. We are more into Torrent, Ipca, Eris, and Ajanta, which are more domestic focused pharmaceutical players where the drivers are very clear. Some part of our portfolio is into the China plus one story, if that is how people love to be describing this opportunity, whether it's a Divi's or a Suvain or let's say a Syngene, or maybe even a Gland Pharma. These are basically companies which are helping the big pharma companies around the world to actually have a low-cost manufacturing base, which these companies here in India can provide without compromising on quality. That's another part of the portfolio. The last part of our healthcare exposure is to diagnostic companies like Dr. Lal and Metropolis. The drivers for this are very similar to what I explained for pharma. Per capita spend on diagnostics, on hospitals is again very low. We find this to be a business with high return on capital. And I think with of course, growth opportunities also, there in the coming years and decades. And that's why we are long-term investors in this part of healthcare as well. Yeah.
Yeah, sure. Thanks, Ajay. There's a question from Mr. Deepan. So his question goes like this. So what are your views on the new sectors or the emerging sectors which you would bet on given your fund philosophy?
No, I would say we don't need to do anything new. There will always be new businesses that will keep getting listed. We have to evaluate them for their quality. If we like them, we'll own them. And I would say that there would be a lot of technology companies that will get listed. Yes, India has 100 unicorns. All of these unicorns have been funded by private equity, and all of these private equity investors will need an exit, which means that over the next 5 years, all of these 100 companies will come up for listing. Not all of these 100 will make money. I would say majority of them will destroy wealth. A minority of them will end up creating wealth. And it is our job to actually, with a very strong research team, to figure out which ones will, be the real long-term winners. So yes, we are always open for new businesses. Some of these new businesses will come on the consumer side, some will come on the internet side, some will come in IT, some will come in healthcare. So all of these new businesses will come out with a new way of doing business. If it makes sense to us, if it qualifies the quality test, if it indeed is a business run by a very passionate entrepreneur, which already has the proof of concept in terms of profitability, strong balance sheet in front of us, we will get excited. Otherwise, we won't. Yeah.
Sure. One last question, Ajay, for the evening. This is coming from Mr. Sandeep Shetty. The question is on passive funds. So is investing in index or a passive fund a good strategy in the bearish market environment? So your views on that? So see, I don't think passive investing has anything to do with bullish or bearish. I would not want to draw a correlation between bearish markets being better suited for passive and bullish markets being better suited for active. I would just say that some investors that we have in our fold are getting increasingly comfortable about passive. And therefore, to these investors, we have a whole suite of products available on our passive platform. If you ask me active versus passive in the long run, I'm ready to take a bet that if you really are focused on the fundamentals, if you really are not attached to the market movements in the short run, and you're really looking at wealth maximization over the long run by investing into very, very strong businesses, then active will be able to beat passive in the next decade or very many decades as well. But you need to have a very sound strategy, and you need to sit in these businesses very, very patiently. So yes, active has a right to win, but how to manage that active is also something we have to be very clear about. It has to be a sensible strategy, and more importantly, it has to be a strategy where you stick with discipline, because no matter how good the strategy is, it will go through its own shares of ups and downs. Typically, people capitulate when you are at a down, and therefore you just give away the ability to see a bounce back because you've already moved out of that style into another style, and therefore you're not able to enjoy the recovery. So long as people are able to stick with their style, active will, in the long run, be able to outperform passive. But yes, there would be an audience for passive, and if people are comfortable only with passive, for such investors, we do have our suite of products. Yeah. Thanks, Ajay, for your insights. Of course, due to paucity of time, we could not take many questions.
If you have any important questions on the chat box, we can still take a couple of them.
Yeah. So one question is basically coming from Anand Dikshit. So it is on the sector funds again. So which are the sectors you think which are looking attractive?
I mean, I would say this is a very difficult question because we are always looking at what is attractive from a 6-month, 12-month period. What is attractive from the near-term period may not be attractive from a 3-year period. Think of the auto sector in 2014 and 15. It was attractive from the near-term view, but then from 2016 to 2021 was a very painful period. So I would just say that please don't look at funds purely from a 6-month or a 12-month basis. That is really not the most advisable way to make money for our investors. You really have to take a long range view. As far as the long range is concerned, many sectors in India provide opportunity, whether it's the banking sector or the pharma sector or indeed the auto sector, also the IT sector. So, there are many sectors. How they would move from one year to the other in terms of price performance is almost impossible to predict. And that's why we also want you to, not just focus too much on what will happen in the next few quarters. Please do focus on at least a 3 to 5 year horizon. Yeah.
Yeah. Thanks, Ajay. So if there are any, I mean, we could not obviously answer all the questions. So I request participants to probably get in touch with your MFDs or our relationship manager. We will be more than happy to answer your any query. And also just a request to the participants here today. So please use the feedback link available on the screen to share your feedback on the topics covered today and also on the webinar in general. It will help us to do better in the upcoming engagements with you. So with that, I will hand it over back to Ajay for closing remarks.
Well, thank you, Niranjan, and thank you everyone for your patient listening. Thank you first of all for supporting UTI, and we really cherish our partnership with you. And I would just want to end by wishing you once again a very happy Diwali and a festive season, a very good, cheerful festive season ahead. Thank you very much. Have a nice evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.